Hey, what's up you guys? Welcome back. So, sorry I've been away for a while. I am not dead, as you can see. I just took a small break. So I figured that I've been making multiple videos a week for the past year or so. So I figured I just needed to step away from YouTube for a bit just to kind of reset my brain and prevent myself from burning out. On that topic though, I do want to give a big thanks to everyone who has been watching this channel so far and who has been giving me support, because we're at well over 4,000 subscribers now, which is absolutely amazing. I know I always bring this up, but I just imagine speaking to a room of like 4,000 of you and how amazing that would be. You guys probably wouldn't even fit inside that room, right? Because, 4,000 people, that'll be a huge room. I'd probably have to rent like a convention center or something. So the next milestone is 5,000, which I'm sure we'll hit very shortly. And once we do, I'll do another Q&A just to celebrate. So anyways, today I want to bring it back to talk about investing basic topics though, because that's mainly the kind of purpose of this channel, right? It's for financial education. And I know you guys love it when I talk about individual stocks, and by all means we'll keep doing those videos. But to be honest, guys, I'm not going to have a new stock to talk about every single week. That's going to be the next 5x or 10x opportunity, right? I mean, I could clickbait you guys and try to farm for more views by putting, oh, this is the next 10x opportunity or whatever. But obviously that's not going to happen for every single stock that I talk to if I'm forced to come up with a new stock every single week, right? So I only talk about stocks on this channel that I actually am interested in. I might not be invested in all of those, but at least that stocks that actually pique my interest that I could see will do well over the long term. Those are the stocks that I talk about. I'm really trying to focus on quality here is what I'm trying to say. But as I said, the result is that I'm not going to be able to come up with a different stock to talk about every single week. So I thought that we'd use the meantime to talk about the investing basics, because I realize a lot of you are beginners and you might be intimidated when I talk about balance sheet analysis or financial statement analysis in general, right? When I talk about individual stocks. So I thought we'd bring it back to the basics, and that's exactly what we're going to do today actually. So today we're going to talk about dividend investing and why I've been kind of shifting away from that for a bit for the past few while. Yeah, it should be a fun video, and without further ado, let's jump in. Okay, first, if you're totally new and you don't know what dividend investing is, what is it? Well, dividend investing is when you focus heavily on investing in stocks, or sometimes exclusively, focus on investing in stocks that pay a regular dividend. So the purpose of this is to build a passive income stream, because there's nothing that you need to do besides hold the stock to be entitled to the dividend if you have a stock that pays dividends. So the simplest way you can think about this is, say if your cousin asks you if you want to partner with him on a business. Say if you're building a bike shop or something, right? And let's say that you two become business partners and you agree to this and you split everything 50-50. So you own 50% of the business. Well, then you'd be 50% entitled to the profits, right? Say if things go well and you make money, and the business is now faced with two choices. You can either just take the profits, and then you can take the profits out as cash, and then you can do whatever you want with it. Or you can, if you see more growth in the business, you can put the money back into the business and increase the value of the business so that you can make more money in the future. So that's exactly the same idea when you're a shareholder of a company, because you're a part owner, right? Even though, let's say you own one share of Apple, well, that's one share out of billions and billions of shares, but still technically you're a part owner of Apple, even if you just have one share. So theoretically, you're still entitled to part of the earnings. So if the management of the company decides to return part of the profits back to the shareholders, well, then that's called a dividend. So some companies are known for consistently paying out dividends throughout the years and even increasing the payout of the dividend as time goes on. So this brings me to the biggest advantage of dividend investing, which is the flow of steady income, as I said. So steady is in air quotes because it's not necessarily always going to be the exact same. Companies can cut dividends in times of crisis prices like a lot of companies did when the pandemic first hit. So you can mitigate this risk though if you just diversify into different dividend paying stocks and into different sectors preferably, or you just buy an ETF, which is again a collection of different stocks, right? So there are ETFs that are specifically devoted to dividend stocks, so you can buy an ETF and the payout will be relatively steady. But on the flip side, there are some disadvantages though to dividend investing, and those are the main reasons why I've tended to prefer growth investing, which is investing in companies that have high growth potential but don't necessarily pay out a dividend. So personally, I tend to prefer growth investing rather than dividend investing, and I'm going to go into details as to why specifically. So the first major thing of dividend investing is that it tends to underperform growth stocks, at least of recently. So I know a lot of you are going to fight me on this and you'll be like,
what about in the late 90s and early 2000s when the dot-com bubble burst and tech stocks got destroyed and dividend stocks did well?
well, yes, if you're going to talk about a specific circumstance when it was tech stocks specifically that got crushed, well, then yeah, during that time, during the dot-com bubble, dividend stocks did outperform. But what I did was I compared a few ETFs, namely VOOG, which is the Vanguard S&P 500 Growth ETF, which focuses on large cap growth stocks, the SDY, which is the SPDR Dividend ETF, which focuses on well, of course, dividend stocks, and VOO, which is just a regular S&P 500 index fund, which has a mixture of both growth and dividend stocks. Well, then you can see that the growth ETF was the best performer out of the three in the past 10 years. And I realized that for the past little while, for the past few months, the dividend ETF has outperformed the other ETFs in the short term. But in the short term, it doesn't really matter because we're trying to focus on the long term here, right? So as to why this is the case, that growth stocks have been outperforming dividend stocks, well, I think that this trend might continue. And the reason is that because tech has been a dominating force in the past few decades or so. So tech has dramatically improved our lives in just a multitude of different ways, and it's become much more influential than it was before. So if you just think about it, this pandemic has only exacerbated the need for technology to become an even bigger part of our lives. So it's no wonder why we're seeing the S&P 500 being dominated by large tech companies like Apple, Microsoft, and companies like that, or Google. Whereas if you go back 20 or 30 years, it was way more like oil, industrials, and just so happens to be companies that are known as well-paying dividend companies. So I'm talking about companies like, again, ExxonMobil, General Motors, General Electric, AT&T, those kind of companies. And I know a lot of you who are watching this channel are also fans of ARK Invest, Kathy Wood from ARK Invest. And if you know ARK Invest, you will know that their investment strategy is focusing exclusively on disruptive technologies. So there are things that are changing the way that we do things on a fundamental level. So you don't see ARK Invest buying stocks like oil stocks or big banks, which are two of Warren Buffett's favorite categories, by the way. So a lot of people think that ARK Invest way is kind of going against Warren Buffett's kind of tried and true value investing. However, I would actually disagree with that because what I think ARK Invest is doing is that they are doing value investing, but they're just defining value differently. And what I mean by that is that value investing by definition is buying great companies at discounted prices. And ARK Invest just believe that innovation is underpriced, which means that when ARK Invest is buying, let's say, Tesla, well, they're arguing that Tesla's undervalued because of their total amount of things that they're disrupting, right? So if you think Tesla's overvalued at like $600-700 billion or whatever it is, well, ARK Invest says not so fast, right? If you just look at how many different fields that Tesla is disrupting, well, then Tesla might be incredibly undervalued. My point is that a lot of these big dividend companies, the companies that are paying dividends right now, they tend to be less innovative companies, and they tend to be older companies as well. And they seem attractive because they provide that steady flow of income in terms of dividend, but the problem is that they lack growth. So if you focus exclusively on investing for the sake of dividends, well, then you could be paying a high price in terms of opportunity costs by leaving gains on the table because you could have used the money to buy growth stocks that would have gone up more. So this doesn't mean that I'm refusing to buy stocks that pay dividends. dividends. Don't get me wrong. A lot of the stocks that I do own right now do pay dividends. But going forward, I'm just saying that I'm not going to pay as much attention as I did before on whether or not a company pays dividends when deciding or not to buy the stock. So I think that, like, for example, for a company like Tesla, I don't actually want them to pay a dividend, right? It would be a disaster if Tesla decided to all of a sudden pay a dividend, because I'd be like, what are you doing? You could have used the money to like grow any other area of the business and just make the business into a much better business rather than just like giving the money back to the shareholder, right? So I'd rather, like, Elon Musk knows how to deploy capital better than I do, or at least I hope, right? So I will concede one thing, that is that it does depend on, like, the dividend strategy does depend on your age as well. I'm by no means a financial advisor, so please don't take this as financial advice. However, in general, the way that people say you should do things is that you should take more risks and go heavier on growth stocks when you're younger, because you have time on your side. And if worst comes to worst, for whatever reason you mess up, well, then you can afford to start over because you have more time, right? So your risk tolerance would generally be higher as well. If you're on the older side and you're going to retire soon anyways, and you got a bunch of kids and you got like a mortgage and whatnot, and you have a decent size investment account already, hopefully, you might be better off just playing the low risk strategy just by investing in dividend stocks and having a stable flow of income. So that might give you more happiness than just kind of YOLOing your money on like growth stocks like Tesla or whatnot, right? Although I would argue that like buying Tesla is not a YOLO, because they're like such an established company now, is gonna probably stabilize in terms of the stock price, so you're not going to see like explosive ups and downs nearly as much as it did before. But that's a tangent. I'm getting off track here. My point is that since I'm in my 20s right now, I would argue that I fall into the first category that I said, right? So, which is the category that favors more high risk in favor of higher potential growth. So I'm going to focus on buying more growth stocks rather than dividend stocks, which is why you never see me buying like ExxonMobil, even though that many people have told me that, hey, this is such a cheap stock, it's so undervalued, and the dividend yield is like 6% right now. So yeah, I get it, and I totally get the argument on why like it might be a good investment. I'm not saying ExxonMobil in particular, but I'm just saying like dividend stocks in particular. I totally get the argument, but I just tend to favor the more high growth plays. So all in all, I love to hear what you think, though. Whether you agree or disagree with me, I love to hear your opinion down in the comments. So be sure to leave a comment down below. And this is just my personal opinion, so please don't get offended. Anyways, be sure to hit the like button if you enjoyed the video, and consider subscribing if you like this series. Be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye.